Welcome, friends. Just want to remind you to head over to my website, putparadise.com, which is focused on options trading and provides training content to beginners. We're delivering consistent returns, potentially 50% annual rate of return, while trading for only 15 minutes per week. You can download my free guide called the PutPath Options Trading System, which is a checklist that outlines our trading methodology. We're actually going to go over that today. Okay, so let's dive right in to how to make an extra $1,000 a month selling options. So I would definitely recommend going through the PutPath options trading system. This is a methodology that I created for beginners, step by step, trying to give you instructions on how to get there, basically looking at starting from very little experience up to making that extra $1,000 a month. So again, go to my website, download the free guide, and stay with me in this video. First step is to open and fund a brokerage account. So typically, a lot of people are going to open this online, which makes complete sense. If you have a brick and mortar brokerage, go ahead and go through there as well. I recommend Robinhood for beginner traders. tastytrade is great for beginner traders. Robinhood has got zero commissions. tastytrade has got the best tools in the business, and they can really help you get an edge on the competition, get an edge on coming from scratch and not having any experience. So they can help you with the basics. It's really intuitive, easy to use, and so is Robinhood. So get that brokerage account open. Next thing you have to do is apply for an options trading account. So there's a form you have to fill out. Every website's a little bit different. They're going to ask you some questions about your background. You have to go in, answer truthfully, make sure that you go through their process to get approved for a level 2 options trading account. Tier 2, some people call it. Make sure that you read the characteristics and risks of standardized options before trading. It's going to give you the baseline for terms, all of the terminology that you need to understand in order to trade options. We're going to be trading put credit spreads, so if you get that level 2, you're going to be able to trade like we're going through today. So we're going to go through an example, and I'm going to teach you the basics of the trading system. So we trade 12 different underlyings. To get the full benefits of the system, you're going to need an account that is 24,000 to 25,000 in capital, in buying power, in order to take full advantage of the system. So if you have that $25,000 and you use the system as we prescribed, what we've seen in the past is that you're going to be able to get that extra $1,000 a month. So I have 6 big ETF names. QQQ, IWM, SPY, DIA are the 4 big indexes. And then we also trade SMH and XBI. SMH is semiconductors and XBI is biotech. Now, to balance some of that out for diversification, we also have 6 non-stock based names. These are commodities and alternative assets. Gold, GLD, IBIT, which is your Bitcoin, USO, which is oil, and VIX, which is your volatility index. We diversify across all of these indexes and alternative assets in order to give us a buffer. When the 4 major stock indexes go down, we have alternatives that should buffer against that. So we want to start small with 1 lot. And if you have $24,000, and you'll have enough capital to do that. So what you see is every time you make a trade, it's going to take up $500 in your buying power. So let's go over to Robinhood and we'll go through an example. So in my Robinhood account, you go down to stocks and ETFs. I have all 12 names outlined here. Let's take QQQ as an example. It's the one that I would definitely recommend as your first trade for a new trader. Very liquid. So you click on your QQQ, click on trade options. We're going to go out to the 23rd of January, which is 32 days to expiration from today. Today's a Monday. We're in the after hours. The market's not open. You're going to go to sell that put. You're going to go down to a chance of profit at 85%, roughly. So we're going to go down to the 585. You sell the put, so you click on the plus. Then you buy the put $5 wide below that price for protection. And then you see at the bottom it computes your put credit spread. So this is a 46-cent credit, which is pretty good. We shoot for 50 typically, but the market was way up today, so you're not going to be able to get the pricing that we typically want. Hit continue. So you go to your screen and you check to make sure everything's okay. All right, so you look at the date. You want the lot to be 1. You want the limit price. Typically we want 50, but 46 is what we're getting right now. Then you would click review. Now, very important here, you can see your max profit's $46, your max loss is $454. So again, you add up those two numbers, you're going to get 500, and that is your span, that's your capital that you're risking. Click review, and then if we were going to trade this, we would swipe up to submit. Now, since the market's closed, and this is just an example, we're not going to do that. Let's go back. So what we're going to do is we've selected our underlyings. You know the basics of delta and probability of profit. So basically, delta, we're looking for that minus 0.15 delta, which corresponds to an 85% probability of profit or chance of profit, which is what we saw on the previous screen. So what that means is when you sell that option, you're going to be getting an 85% chance that it stays out of the money and that it's profitable for you. And then we sell the $5 lower as a protection, as a worst case scenario, if the underlying does start to move against us. We trade out of the money, and it's going to be around 5% or so below the current stock price is going to be the strike price, and all of that's computed by your apps based on the Black-Scholes model, but it's just a rule of thumb. It's going to be about 5% less typically. Again, so we're using laddering as a concept and days to expiration as a concept. So days to expiration, we shoot out 4 weeks, so 28 days to expiration, up to 32 days to expiration. So if we're trading on Friday, it's going to be 28 days to expiration. Monday, Wednesday, Tuesday, Thursday, whatever it is, those days will have more than 28 days to expiration. So it could be up to 32 days to expiration. And what's the concept of laddering? So laddering means as we're putting trades on this week, the trades that we put on 4 weeks ago are dropping off. So what that does is it has capital efficiency. It conserves your capital, makes sure that you are maximizing your buying power. So one thing to understand with that $25,000 is that theoretically you could lose all that money. That is the worst case scenario. That's a black swan event. That's catastrophic for the whole globe in the financial system, but it is theoretically possible to happen, while highly, highly, highly unlikely. But want to keep that in your mind. Do not risk more than you're willing to lose. It's just like gambling. Don't risk more than you're willing to lose. Now, in our case, we're actually the house on the trade. We are taking the more conservative, the highly probable position that the stock will not go down past our strike price. So we are the house. The person who is buying that put is gambling that there's going to be a sharp downturn. So we're betting against that. So we're taking the more conservative approach. But just so you know, that is out there, that the stock or the underlying can move against you, and theoretically all 12 of them could, which is the worst case scenario. So step 6, we're using $5 wide spreads. I choose $5 wide because mostly we're into the $100 to $500 range on our stocks. With $25,000 account, you're only going to be able to have one lot with this system, which is fine. One lot diversified across 12, having a time diversification element across 4 weeks puts you in a very powerful position. So it's great. Lot size 1, keep it small. You're still going to be able to get your $1,000 a month. So risk controls. So very important part of this system is knowing when to close out your trades. We close out at a 2x loss, which is also a 200% loss. So let's go back. So you can see my positions held. So here's what I have on currently. Now again, I have 3 different accounts. I've got tastytrade, I've got Robinhood, I've got Fidelity. So not all 12 underlyings are going to be here. But what you can see is I have a wide variety of underlyings. And you can see by the first one at the top as an example, I have made 97.37% since that original trade. So the two that I'm concerned about is the VIX, I've lost 48%, and the TLT. So when we start to get concerned is when it goes from 48% up to 200%. Once it hits 200%, we close the position. No ifs, ands, or buts. It's very important to close. If you don't close it, the system will not work for you. You'll start to get into higher, more catastrophic losses, and you could potentially even lose money with this system. So very important. Close out at 200% loss. Take emotions out of it, just close it out. Okay, so step 8 is just giving you the motivation. If you've already gone through, you understand the concepts, you understand what we've talked about so far. So you want to go ahead and put on these trades, open them up, and you can see the example here in the guide. So the time has passed. What we do at the end is close out the trade. You want to avoid assignment risk. You want to avoid a loss. And you want to avoid having a trade that you don't close that is close to being in the money that you have to worry about on that expiration Friday. So very important. You have to go in and put in closing orders. So you can see here under my pending orders, I have a 2 cent trade in. Now a couple of these I put in at 10 cents, and why is that? So I've been trading RUT in lieu of IWM and NDX in lieu of QQQ, and there's reasons for that we don't need to get into in this video, but it's instead of a $5 wide, I've been trading a $25 wide, and instead of a 2 cent debit, I've been putting in a 10 cent debit. So it's basically 5x what you would do with this system. But to illustrate, I have a 2 cent debit for that IBIT at 41 put at the top there, and I would expect tomorrow when the market opens, you can see the bid-ask range is between 0 and 2 cents. It'll execute and close out that trade. So I put all these closing orders in, and then once the time compresses and I get the theta benefits and the trade has not moved against me in terms of delta, the underlying has not went in the money, and the trade is worked out, all of these will go ahead and execute. And I take that 2 cent debit and put it in right when I make the trade, get it on. You put it in good till canceled, and then once it gets down to the 2 cent level, it'll go ahead and execute. And that's best case for us. All right, so again, very important. Do not ever let a position go in the money. If it gets close to in the money, close it out. Do not let it get worse off than 200% loss. If it does, close it out. You don't want to be messing around with assignment, and you don't want to have anything that goes into that expiration Friday close to being in the money, because some funny things can happen in after hours trading. So that's basically it. Just want to give you encouragement. This takes about 15 minutes per week. After you get it down, it's like 1 minute per trade. You can do it on Friday, on many days during the week when we have higher volatility, and we have good setups. I'm going to tell you guys when to put the trades on Monday to Thursday as well. But it's a simple system. It's highly effective. It's very time efficient. It's very capital efficient, and it's an easy way. It's a way that has risk management built in, and you shouldn't have catastrophic losses as long as you're monitoring your position and closing them out. So if you have that $25,000, you can have a traditional IRA. You can have that in a brokerage account if you want to have access to your money, and be able to take it out and go spend it for a vacation or whatever it is. Then it needs to be in a brokerage account. That's it. Rinse and repeat.